So I want to take this opportunity to understand, the profile of the audience, a little bit about yourself. So how many of you are entrepreneurs here? Oh, wow, that's a good number. And how many of you have been funded, seed, otherwise? Okay. Okay, good. So, there are a lot of other participants, entrepreneurs who are really in the process of seeking funding, and this session becomes highly relevant in that aspect. So the panel discussion is going to address a few key aspects. First one being, when is it that you look for the Series A kind of funding, and how do you move to the next level? So there is always this question within entrepreneurs as to, when is the right time? Am I ready for funding yet? How do I make myself more attractive to the investor? What are the challenges that late stage investing has? These are some of the questions that are going to be addressed by the panel today. We have with us on the panel an investor who has a formidable experience in early stage investing, Mr. Parag Dole, who's the MD of Inventus Capital Partners. And we have an investor who specializes in late stage funding. We have Mr. Atul Gupta, principal at Premji Invest. And of course, we have two entrepreneurs who have successfully raised late stage funding. One of them is Mr. Bhaskar Subramaniam, CEO and co-founder of Amagi Technologies, and Mr. Anish Reddy, co-founder of Capillary Technologies. So this session will be moderated by Professor Sabri Nathan, Associate Professor, Finance and Control at IIM Bangalore. Professor Sabri has been the chairperson of NSR Cell and also a venture capitalist in his earlier years. So what makes this event special is the fact that Professor Sabri and the NSR Cell team had conceptualized 4 startups about 5 years ago, and today, the kind of audience that it's attracting is really great to see. Professor Sabri, without much delay, I would request you to take the proceedings further. Thank you.
I want to thank NSR Cell for putting this event together, and I want to thank all the audience for being here on a Saturday morning, because we've put together a fantastic panel this morning. Before I introduce the panel, I want to sort of go back to the session prior to this break, and I want to clarify a few things which my students Aditya and Hana did a fantastic job of making the presentation. I want to thank them for that. But, thank you very much. In some small way, I'm part of that mischief that they presented to you. And so I need to sort of clarify where we are coming from in what we did. First of all, as academics, so the motivation for that study was, when we started asking ourselves, what has the industry been up to? There were many questions for which we couldn't find answers. Okay, there were some study, there was an article that was written by IIT Chennai some years back, which went on to say that India is not a follow-on funding market, right? And so as academics, we went with an open mind. And so we started asking questions, what has the industry been up to? We took a 15, 18-year view. And we found a few interesting things, which is what Hana and Aditya presented to you. And I don't know whether you would have expected those answers, but we were surprised to see those answers. And if those answers are out there already somewhere, then we as people who've been looking at the space have missed something very, very critical in terms of what's available as literature. So we clearly didn't know that there were 3,700 companies that had been funded. We didn't know there were 9,000 transactions that had taken place. We didn't know there are 850 investors, right? We didn't know that a third of them have gone out of business, okay? We didn't know that there is a 20% exit rate in this market, right? And, people bring out annual reports on the industry and everyone cribs about this market being illiquid. And what we have seen is a case where you can take it as a glass half full or half empty. And we think we'd rather believe that the glass is half full rather than half empty, right? The other thing we found is that it takes about 4 years to exit from an enterprise, which is, I think, a lot more encouraging on average. If you look at all the exits that have happened, the 720 odd exits, it's taken them 4 years from the time they were funded first by a venture capitalist. To my mind, that's an extremely encouraging statistic from the point of view of an investor. I would think it's a lot better than probably many other markets. My venture capital colleagues can, can at some point in time talk about whether they agree with that observation or not. But the fact is, it takes us 4 years to exit invest, 4.2 years to be precise. And the other interesting thing we found is that all of those companies put together have been in some portfolio or the other for not more than 6 years. The average holding period of the entire portfolio is just 6 years. Clearly, there are some investments that have been there for longer, but on average, investors are holding a portfolio for not more than 6 years. So net, the sense we come away with is that it's an overall encouraging picture. So the reason we also wanted to do this is that oftentimes we go by what a newspaper says. So suddenly on one Thursday morning, this newspaper would say, venture capital industry is going through a downswing. And 2 weeks later, venture capital industry investment picks up. It was all completely maddening to us, happening on a fortnightly basis. So we said, let's take a longer view. So that's what we did. So there are people who said, can we get return data? Why are you not giving names of companies? Unfortunately, as an academic institution, there are certain, norms that we have to follow in terms of what we disseminate. So we can't put out, which is why you have those 15 funds named 1, 2, 3, 4, 5, 6. Those who are in the industry can easily guess which ones those funds are. I don't need to tell you that. But as an academic institution, we can't say that somebody is on top of the league tables. That's for a consulting firm or an industry brokerage house to tell you. We can't do that. We can't also tell you, who is ahead of the pack in terms of returns and that sort of stuff. That's, we're not expected to say that. We're also not supposed to give you definitive answers to why we think certain things are happening. Because there's a lot more scientific rigor, which by the time we reach there, most of you won't understand what we're talking. That's a tragedy, okay? But we're not supposed to tell you for sure that this is why, certain sectors are hot, this is why certain sectors are not hot, et cetera, et cetera. So we followed that academic discipline or standard or whatever you want to call it. So that's a long explanation to some of the questions that came up before we got into the panel. I want to start introducing the panelists first without further ado. I've taken a lot of time already. So I'm going to go in the alphabetical order because it's hard for me to decide who is most important for the panel. All of them are equally important. So I fall back on this lame old technique of going by the alphabetical order. So Anish Reddy first. So co-founder and CEO of Capillary Technologies, alumnus of IIT Kharagpur. Aditya will introduce Capillary Technologies more formally through a slide in a while. But both Anish and Capillary have been featured in Harvard Business Review, Forbes, TechCrunch, Gartner, and they are a recipient of Fortune 40 Under 40. So apart from all of this, Anish is also a half marathoner, and he's on the governing council of iSpirit, so that's where he contributes to development of the ecosystem. And iSpirit, as you all might know, is a think tank which envisions to transform India into a hub for new generation software products. So one of the reasons I'm very, very happy to have Anish on this panel is that wherever I go, especially in the early stage funding circles, whether it's BIRAC, whether it's DIT, and the name of Capillary keeps coming up. It's very closely associated with the success from IIT Kharagpur. Anish was also the founder of the entrepreneurship cell in IIT Kharagpur. Thank you very much for being here this morning, Anish, and welcome to this panel. Next on the panel is Atul Gupta. Atul has a BTech from IIT Bombay in chemical engineering and an MBA from the Haas School in Berkeley. Atul has had a significant operating experience. He started Novellus, was there for almost 8 years, and then he went to Applied Materials, and after that he went to Deutsche Bank. He was a technology investment banker, and then he's been with Premji Invest for the last 8 years or so. It's pure coincidence that he's also on the board of Amagi. I can promise you that it wasn't by design that we have an entrepreneur and his investor on the same panel. And I hope that they will not let us down by not having enough fireworks right in public. Okay, the entrepreneur-investor relation is a very strange one. It's more interesting than man and spouse. Okay. And the third panelist for this morning is Bhaskar. Bhaskar is part of IMB pretty much, whether he wants it to be or not. We have co-opted him as part of the IMB community. Before Amagi, he'd started ImpulseSoft, and he sold ImpulseSoft and started Amagi. Bhaskar is very generous in acknowledging that Amagi was born in the Cafe Coffee Day outlet just outside this auditorium. And so Bhaskar, for sake of formal introduction, has a BTech from Coimbatore, went to IIT Bombay to do his MTech, and wisely decided it wasn't worth his while, and decided to start Impulsoft. And his LinkedIn profile says that he's a dreamer who is passionate about creating world-class product companies, technology companies. At Amagi, he drives strategy as CEO and business development. On a lighter note, NSR takes equity from companies. Amagi is one of those companies in which we didn't take equity, and I think we would regret it. But I think on a more generous note, positive note, we've gotten back much more from Bhaskar than we would have probably from the equity. So here is the rub. Here is the rub. If you had insisted on equity, Bhaskar wouldn't have probably incubated here, right? So some way or the other, we extract our pound of flesh, although we are an academic institution. Okay, and last but not the least is a former colleague of mine, Parag Dole, and also an alumnus of IMB. So we do tend to be a little parochial from time to time. So Parag has a BTech from IIT Delhi, right? I kept saying IIT Kharagpur until the last time he ticked me off. And so IIT Delhi, and then MBA from IIM Bangalore. He's had operating roles as well as, but the bulk of his career has been in venture capital. He's a managing director in Inventus, and he's been associated with companies like Redbus, which got acquired, Funds India, Vizuri, eTechies, Power to SME, Policy Bazaar. So if you look up the net, you will find that most of these companies are doing extraordinarily well. Very disciplined Series A investors. When the market was going berserk, doing a deal a month or doing 2 deals a month, Inventors dug in and said, no, we are not giving into that temptation. And to my mind, that's a sign of a mature mind, and they've sort of held their ground in that sense. And so broadly, the method, if I can call it that, behind this apparent madness, to use a cliche, is that we said we'll have a Series A investor who will tell us how they prepare companies to go to Series B and beyond. We'll have a later stage investor who will tell us what they look for in a later stage investment. And we'll have 2 entrepreneurs who have been through that journey from going from Series A to Series C in the case of Capillary, and Series A to Series D all the way. Amagi just closed their Series D. So they'll talk about their journeys. And we'll do that through a series of questions that I will pose to them. And then we'll open the floor for Q&A. So that's roughly the plot. Just by way of clarification, at the risk of repeating what I said, I want to emphasize this. The focus of this discussion is on going from Series A to B and beyond. I know there are lots of people in this room who have not raised a Series A, who are wondering, how do we go about raising a Series A? I'm sure you'll have a lot of legitimate questions there. But I would very much like it if we allow space for those questions that relate to going to Series B and beyond. And once we've exhausted those questions, if we still have time left, I would like to address questions about raising pre-Series A or Series A round of funding. I'd like that to sort of, so, just to sort of close, I know I've spoken a lot this morning. Back in IMB, we've always kind of taken the conversation to places where other people haven't been to. So we started talking about ESOPs for entrepreneurs much before anybody else did. We started this For Startup show before most others did. Sometime back, we said that angel investors have extremely concentrated portfolios, which has its own problems. And then 6 to 12 months later, Inc. 42 published a list of 1,000 enterprises that went up in smoke, and a large number of them are angel funded, right? So as far as we can see, nobody has spoken about going to Series B and beyond. Everybody talks about Series A and pre-Series A. So we wanted to take the conversation to a place where nobody else has been before. So this is a part of that endeavor. So I'd appreciate if you can keep it that way. Let's focus on Series B and beyond. Time permitting, we'll go to other Series A type questions. Okay. Before I hand over to the panelists, I want to sort of invite Aditya quickly to give a one-slide introduction to all the panelist organizations, and then we can have a sense of context for running the panel.
Thank you, sir. So first we see Capillary Technologies, and sir has given pretty much the introduction that we wanted to give, but to get into some more specifics of how successful the company has been. First off, it started in late 2009, 2010, and was the winner of Qualcomm's Q Prize. if you look at the model, what they're essentially trying to do is to better customer engagement across omni-channel retail. So they link up from retail point of sales data to capturing that data through their proprietary suite, performing analytics and insights to look at how can you better improve the metrics in areas of customer loyalty, engagement, improving the sales numbers, average basket value, and of course promotion effectiveness, and to formulating ideas and strategies that are highly actionable. Going forth, the company saw a fairly exponential rise in terms of the brands that they were associated with, the customers that they were acquiring, and as Sir had mentioned, they were heralded by the Harvard Business Review as a shining example of reverse innovation. That's a case that they still use today as an example of reverse innovation. With subsequent rounds of funding, they also acquired MartJack in 2015, which is an e-commerce platform, thereby going from customer engagement to commerce as well. And as recently as August 2016, from what we can understand from public sources, they raised a Series D funding from Innovan Capital. So thank you, Anish. That look probably gave a bit of a...
No, we didn't raise a Series D. Okay. It was more, as companies tend to get closer to profitability, the need to raise money is not as much. So you then start raising debt because you know that you can start paying the debt back. So Innovan was more a debt. It was $1 million debt, something like that. So yeah.
Thank you for the clarification.
So moving into Amagi, here, so this is basically a timeline of how funding happened for Amagi. Like Sabi sir just mentioned, late 2016, they did raise Series D funding. What Amagi does is it sort of provides geo-targeted TV advertisements. So for a long time in the space, you had media planning agencies, you had large advertiser firms, and you had broadcasting channels. So you had big players that could only, put their advertisements to reach the audiences through television. But now with Amagi as an intermediate player, they have been able to use a lot of their technology in order to have even local players and target the sort of advertisements that viewers are exposed to.
So Inventors Capital is, of course, the first of the two venture capitalists that we have on the panel today. To describe the firm, as Sir mentioned, it is an early stage fund which focuses on technology. So it looks at areas such as internet, mobile, software, and tech-enabled services. The investment size is given there. For example, it's about USD 1 to 3 million. And the investments that they've made are names that quite a few are familiar with. For example, Redbus, Policy Bazaar, Power to SME, Poshmark, and Peelworks. And of course, you can visit the site, the link given there.
Premji Invest, on the other hand, is a private equity firm that takes part in a lot of later stage investments. They were founded in 2006. And so far, they funded a little over 40 publicly and private companies, publicly listed and private companies, with a corpus of about $1 billion. Their investments include Amagi, there is Cyanogen, Policy Bazaar, and a lot of the other brands that you can see on the deck here.
Yeah, thank you, Hannah and Aditya. With that, we'll start going to the questions. So we have, I've put together about 5 questions that I will run past the panelists one after the other. And I will go strictly in the order in which they are seated. And I'll pass the mic around to them. And I'll leave it to them to respond to these questions the way they think appropriate. Okay. So the first question I had, obviously, is at what stage of its evolution does a company start planning for a Series B or a Series C, assuming it's been venture funded? So you want to start, Bhaskar? What's a good time to start thinking of Series B and so on?
So short answer would be when you run out of money. But okay, a longer part is, I think, it's at a point of maturity where you're starting to scale. I think the next series of beyond Series A, it starts to come when your business model is largely in place and you're looking to really scale the business at that point of time. So that's the sort of time when you start to really look at looking at Series B as funding and beyond. Series C, B, C, all of this most largely scale money in this country. And I think that's the stage you start to really look at it. And at that point in time, you should have a business model in place. You should have an understanding of how the economics of the whole model works. I think those are 2 critical things to really look at before we start raising money.
And by the time I think they kind of have a prototype in place, they want to go after Series A. And they are trying to just test out their model with, in some cases I would say they are trying to test out their model with few customers, while in some cases it will still be early. They are still in the technology development phase where the product is not yet ready to be tested out. Once I think they go through those two phases, the product is somewhat ready. Then I think Series B is when they are really starting to think about the business model. They are trying to think about the milestones that the company should have as kind of it starts scaling. So as Bhaskar pointed out, it is really at the point where you really want to go out to a few customers and test out your model. That's where probably Series B happens, because you now need maybe a couple of sales guys. You now need a little bit more than just the founders as a team, and all of that needs a lot of money. And beyond that also, I would say there is another step, which is that you've now tested out your model with some of the early stage customers, or I would say the leaders in terms of accepting innovation. Once you've tested it out, and now you want to really grow it to a larger base of customers. So that's where Series C and Series D and Series E, so on and so forth, comes in place. Because the idea is that as you would grow, means for an enterprise, as you would grow, you would need more sales force. You would need more regional presence across the regions you go into. And if you're a B2C, it means very large volumes. And to cater to those volumes, it means a lot of processes, a lot of people, a larger organization to really take care of those issues. So that's really, I would say, how I think about the journey of a company.
You know, again, adding to what Bhaskar said, if you don't need to raise money, don't raise it. You know, and I think what's happened in the ecosystem is also that you know, there's just so much money that you know, people feel a B, a C, or D is how you would get qualified on how well you're doing. So again, I would say to the point that Atul said, a Series B is around the time when you really want to go scale. You know, in SaaS parlance, and we are a software as a service company, typically when you're at the $500,000 in run rate, which is let's say the 25 lakhs a month in revenues, is when you know, I think a lot of Series A investors start taking you seriously, you know, around that mark, and I'd love to have Parag comment on that as well. And the Series B is probably more between the 1 crore to 1.5 crore a month. You know, so in our case, you know, when we wanted to start expanding our international very seriously is when we did our Series B. And when we were more, you know, our India setup was good and we wanted to experiment with, start experimenting with with international is when we did our Series A. So I think around the 25 lakhs is the Series A. You should start thinking of your Series A around that time. And I think around the 1 crore-ish is when you should start thinking of your Series B. So it's generally the founders who lead the, you know, activity on the investment side. And in our case, I think what are, as Parag pointed out, I think a lot of the inbound for the Series B would come from, you know, either people mailing in directly or through investors. You know, so investors generally ask other investors who are already in the company that, look, we're interested in what Capillary is doing. So a bunch of introductions come in that way as well. But you know, to be very frank, I think I would have loved to have a big plan of going from the Series A to the Series B. You know, but in most cases, you know, it's very hard to look 2 years ahead in a startup. In fact, I should tell you this: we don't even hazard putting budgets for more than 6 months ahead. You know, it's no point. I mean, it's just like you could use that piece of planning, that time for planning anywhere else. So in our case, it's always been more governed by, you know, so once we are near the 12 months of runway in the company, you know, there's 12 months of money left in the company. It typically takes between 3 to 6, 7 months to raise a round, or to not raise a round, right? At the end of 6, 7, you know, कि नहीं होने वाला है. So we typically, around that period is when you start thinking of, okay, you know, so I need to start raising the next round now. There's 12 months of money left. And at that point in time, at least what's worked for me very well is there's a bunch of inbound that you would generally have. You know, once you've raised your Series A, is when a lot of people will come and talk to you. Potential Series B investors will talk to you at the point you've closed your Series A investment, right? So, and so at that point in time when, you know, I have this internal rule of saying, let's go back to the 5 people I like the most who spoke to me. And if one of them or 2 of them or 3 of them come up with a term sheet, you know, then you're happy, right? Then you don't need to do much. Otherwise, otherwise you can get an investment banker because you need to spread the thing out, etc. But in our case, we've generally seen, you know, in that first 5, 6, you know, we've been able to get the term sheet out in a sense. So, yeah.
So I would say basically, I mean, the word changes when the company is raising Series B or looking to raise Series B versus when it's looking for a C, D, or E kind of rounds in many ways. Because I think Anish just mentioned that they typically would not want to hazard a guess for a plan beyond 6 months. They can probably think about starting to raise a round when 12 months of money left. But typically in the PE world or late stage, when you enter, you typically want to be a lot more proactive as it gets to basically C, D, or E in subsequent rounds on many fronts. So I think, so first question first, I think Dr. Shabri's question was, is it investor-led or is it founder-led? I would say it is always founder-led in terms of they have to decide that the company needs money now. And investors typically, if investors are sitting at the driving seat, I think there is already something wrong to begin with in the company. So founders have to really be gauging as to what is the plan, how am I doing versus the plan, when do I need the money? I think they need to have that vision. And based on that, I think investors can only give them inputs because as you can see, Series A, probably there will be 1 investor, Series B, there will be a couple, Series C, 3, maybe 2 or 4. So the numbers increase and it becomes really difficult for the founder also to manage each of their expectations because one guy may be very aggressive and say, take the company all the way to until 3 months of cash is left and then decide, do we need to raise now? The other guy might be very conservative and say, boss, 18 months. And if once you have 18 months of cash, you start looking for funding because I am very uncomfortable. So I think you'll see all different kinds of flavors in the market. And I think the key in all these is basically having a solid planning as you especially get towards the late stage. Because early stage is still a little bit of, I would say, game of roulette in some ways because you are really trying to shoot a target. You may hit it, you may miss it. But as you get towards late stage, there is more money involved. There is basically a business plan is kind of more well laid out. You have actual customers. And there are many people in the organization. So as a founder, as an investor, you have a lot more responsibility to make sure that the company can continuously move forward. And to that extent, I would say that it's always a teamwork, but the founder is always leading the most of the work.
Yeah, in my scenario also the same, right? So when we started, Series A to Series B was largely driven by the founders. And I think that's very consistent with all the discussions that we've had largely. One of the interesting stuff as well is I think during Series A and post-Series A, we had started already engaging with other investors and investor friends in some sense, right? Because this is a small community in some sense, to understand what would be the sort of milestones which help them to get into a Series B. That means you are upfront kind of deciding what it takes to get there. And this could not be exact quantitative numbers, but kind of a strong stroke of brush that you had in saying, hey, these are the places where I think the maturity of the company should exist for a Series B equivalent stuff. So in some sense, you're kind of starting to set milestones, like what Parag said. Maybe not internally driven as much as possibly an external driven mechanism as well, where we started talking to the investors saying, hey, what do you think is a point where you think it's investable from your perspective? It could be the quantum of money, as well as what do you think should be the maturity of the company in some sense, right? So that sort of helped us to set some sort of a guideline, a guidepost in some sense to go after in some sense. Third, like what I think what Atul rightly pointed out, were there stories, Atul, or were they true? Some investors wanting 3 months and some was...
No, I think these are all true because we see all flavors of
Okay. No, we've gone through all of that, and I think... So basically, as I think Atul slightly pointed out, and we should discuss that later, is that as you have more and more investors coming in, obviously there are conflicts, and I think there's a question on that. We'll try to address it as part of that. But largely, if you look at it, Series C, I think, is about real customers, real business in place, and you have basic metrics in place in terms of how you're going after a particular business model. And in our scenario, the business model was fairly complex. And we kind of set the business model in place and got it to a point where do we know, and like what Parag was talking about, do you know that there is enough margin in the business? Are you getting an efficiency in the business? It doesn't matter whether you're getting it or the ecosystem is getting it, but do you know that there is efficiency in the business? So the first step in the evolution of any business model is there efficiencies or is there money to be made in the first place? Once you know that, then it's how do you extract that over time from a strategic perspective, the next step. And I think Series C and beyond does help you to scale both the business front as well as kind of extract that efficiency out. So those are the sort of steps I think we should look at.
What do Series B and later stage, and I know you clarified to me you're not even Series B, you're Series C or beyond, but what do later stage investors like you look for in terms of preparedness of the enterprise, and what level of development do you want on the organizational front in terms of top management and so on, and what kind of governance structures do you see? Do you want a full-blown top management with governance processes in place, reporting, disclosure, etc., or are you willing to live with a fair bit of rawness there, as it were?
So I think series when you're really coming in Series C, Series D, and you're really looking to invest 20, 30, 50, $80 million in those rounds, I think one of the so unlike a VC model, which actually is built for accepting huge failures, the late stage investing or the PE investing model doesn't really support too much of failures. So I always often think about this, that an entrepreneur, if he fails, he's basically made a public figure, and he can write books, and those books will sell well. And an investor fails, people will say, lost money, and nobody will ever, his career is over, right? So that's a dichotomy you see in the market. So I think late stage investors do not really have the rope that I would say early stage guys have. Obviously, there is the early stage guys operate in a highly risky in an environment where they don't even know if there is a real company or not at times. They are really betting on people. While the late stage guys are betting on something more than just people, they are betting on a real business that has built up by that time. So I think in terms of the key ingredients, there are huge differences, I would say, or Parag can correct me. But in terms of what our expectations are from the business, when I am investing in a business, I am typically looking at a liquidity event which is linked to liquidity event of all the investors. So I am looking at that company and saying, can this company actually go IPO in next 3, 4, 5, 6 years or not? I am looking at basically, are there actually strategic players out there who would be interested in the technology of this company if the scale cannot become too big? So I think there are a lot more considerations around exit that you're looking at that particular point in time, while probably an early stage investor is probably looking at the next round of funding, and because Series A investors typically would want to liquidate somewhere when C, D, and E are happening because their stake is reducing sharply. So at some point, they may look for a secondary exit. In some of the companies, they will have a huge home run where they would look for an IPO exit and make really 10x or 20x kind of returns. But for PE investor, I think those are too far. Those are really not the right way to really look at things. In terms of, I would say, the maturity of the company, obviously a proper organization in terms of the management team is very, very critical. We, at least in all our companies, we always are constantly monitoring. Is the management adequately equipped? Are these the people who can actually deliver the company or not? So there are a lot of those considerations that are going in the mind when we are invested in the company and are constantly looking to scale it up. Along with that, I think, as you rightly pointed out, means when you go into a Series C and sometimes even in a Series D company, means the way the board meeting happens, and I and Parag often talk about this. These are really just a couple of hours of just talking. The governance standards from that perspective are somewhat lax. And obviously, basically, you cannot tie up the founders in too much of bureaucracy either. So I think that is also we understand that. And our view is that's why to just identify the key components where we should be focusing on and just focus on those. And as the company grows, there are many companies basically which have grown from maybe 100 to 500 crores. And now you are starting to think, okay, what are the challenges that we have encountered in this growth? Are the receivables not coming through? Do we have a strong finance function? Are we making sure that the receivables which are 90 days and beyond, are we continuously following up? What are the processes? How are we basically qualifying our customers so that we are giving receivables to only credit-worthy customers? So there are many such considerations that start coming into. And obviously, management team is always kind of thinking through. But in tech companies, the challenge is always that there's huge growth, and you really want to go after the scale and growth. And some of these things typically get either, I think, just missed. They just miss out on these things, or it's just not the focus. Means cost is never the focus in some of the tech companies. Very few tech companies, especially in enterprise, I think they will start focusing a lot more on cost. But typically in the B2C companies, it's only revenue. And no focus on cost. So I think there are a lot of those kind of issues that as an investor you have to kind of work with the companies and try to focus them on some of these aspects.
No, I think there are really two kinds of Series B and Series C, D investors, and I think as we speak, the private equity space is also getting disrupted a fair bit. One is I would call the funny money investors, and the second is the more sensible investors like both of the people around me. So the funny money investors are people who don't care about all this, he said. So they would just say, look, it's like a Tencent or a Tiger or a SoftBank or there are folks like that, where it's essentially they just go behind, okay, this can be like a $5 billion or a $10 billion outcome, and I'll just go behind it. So there's no realm of, it's just a large opportunity according to them, where I don't think, the play is any of profitability, unit economics, any of that stuff doesn't matter. It's just that you're going behind this really big opportunity. You're really going behind the 1 billion Indians in a sense, And in that case, you should not even focus on, unit metrics, etc., etc. You're wasting your time. On the other side, then you have more sensible investors, Warburg, Premji Invest, etc., where I think some of the stuff that you said works very well.
I just wanted to add, from a Series A investor, I think a partner of mine says it beautifully. Our investment philosophy he describes as, or investment attitude he describes as swag, scientific wild ass guess is what it stands for. So I think that's a Series A description for you. Let me give you an example of that. So after we completed the Redbus exit in 2013, there's this girl from KPMG who writes in. She had done the financial due diligence for us way back in 2009. It was a 50-page report, but for saying that you should drop this, they had said everything else. Because it seems like selling tickets seems like a very simple business, but at the end of it, there are 850 bus operators, systems talking to each other or not talking to each other, reconciliations. My God, it was a mess. Now, our view was very simple, and she gave us credit for that when she wrote in. Our view was simple. Here's a guy we believe in. Here's a large market. The systems are not in place. It is a Series A company. His intentions are not wrong. he'll mature. He's a young guy, 26, 27. He'll realize the importance of stopping these leakages. On that basis, we went ahead. I can almost guarantee to you that any Series B or Series C investor in this country, after getting that report from KPMG, would not have done this deal. It's not possible. They wouldn't have been able to justify it to themselves. So that's the call that we have to take, intent more than process. By the time it comes to this guy, Atul, this has to change. Otherwise, that company can't get Series C money. So I just wanted to give that example.
I think it goes back to the fundamental realization that investing money is also a business. And that's important to understand and empathize. So and as entrepreneurs, that's why first thing to read up, what does it take to really invest and exit? It's a pretty hard business, I can tell you. If I'm on the other side, I would have really been scared of how do you go invest in companies and more larger sums of money that you're going to put in. What's the risk involved starts to become higher. In that sense of the word, if you look at it from a VC sort of standpoint, they're looking at anywhere from 5x to 10x sort of returns over a time frame. Obviously, smaller money, that means I could put in many different ventures and henceforth look for probability of success over many different ventures. Versus when it comes to a private equity, it starts to become possibly 3x and maybe he's looking 5x, but 3x and equivalent. But once you start looking at that, then the risk profiles that you want to go after, and because the quantum of money becomes higher, the management time that you can spend across multiple companies is also lesser. So it's critical for you. As entrepreneurs, we start looking at saying, okay, when they put in the money, what are they expecting and how do we really even guarantee in some sort of an exit over time? And what should be the timelines to look at? I think that empathy between entrepreneur and investor makes a lot of difference in terms of understanding the businesses and henceforth being able to have an accommodative approach towards going towards the ultimate goal for all of us the same in terms of maximizing returns for everybody. And if that's clear, I think the road's much more smoother.
I just want to add some controversy to the panel now. So you've told about profitability and the metrics, et cetera, and you've also put a large check into Snapdeal. Now tell me how.
So one, we didn't put a large check. We put a very small check and at a very sensible valuation at that time, which is significantly lower than where the company was valued last round. So I think to that extent, it's always a very thoughtful approach from the risk-adjusted perspective. So I think...
I think then we're seeing the Oyos of the world, the Snapdeals of the world raising hundreds of millions of dollars. And, I think those are the investments that get talked about and not really the more sensible ones. Then how do you think they are happening?
They are talked about more because of, I think, the media interest and...
What are those investors?
No, correct. So basically, as you rightly pointed out, there's a lot of funny money that is out there. And people basically feel that they've missed out on India, they've missed out on India e-commerce story. Any sensible guy looks at a company and says that the valuation can run up from 500 million to 8-10 billion in a year, means I don't think India is as a place, any company in India can scale up that fast. So the companies don't justify valuations. I think the investors try to justify it as a missed opportunity. And hence basically, and this messes up the system. I was in a panel just a few days back about how difficult is exit versus entry. And there was one company there in the panel which basically, which is again one of the hyperlocal focused companies where they've seen the up and down of the valuations very, very quickly. They have one of the fast money investors in them. And he was just basically, you could feel the impatience or the angst with which he was talking about, which is that means when these kind of investors come into the company, their expectations are also very, very different. They are basically looking for a company on steroids, and they want the growth to never come down from 500 or 1,000%. And as soon as the growth comes down from it, means they are just off the company. And most of the founders also typically, what ends up happening, if they get an investor like that, they are forced not to think about anything else but GMV, which is really means nowhere. We had this in 2099, 2001 time frame where companies got valued on eyeballs. How many people are looking at my web page was a measure of the valuation of the company. But that doesn't really change anything fundamental in the company. So I think if we can be very methodical and I think rational in terms of making those decisions, then I think we can take the right decisions at the right point, and obviously have to hold ourselves back when things go south.
Okay, thanks a lot. And I was kind of hesitating a little bit, so I worked on the sequence of my questions in a way that we could get some safe things out of the way first and get into the trickier territories later. But Anish seems to be spoiling for it earlier than I would have hoped to. Okay, so the next question, actually the two questions are related in some way, but let me start with the first one. So are there key differences in the ways in which an early stage investor like you and a late stage investor like Premji Invest engage with your portfolio companies? So what is the investor's take on that? And do you as entrepreneurs see any difference in the way the issues they focus on and their style of engagement, the level of hands-onness, if I can use that word, and so on?
We have an internal joke in the company, and so we've Sequoia, Novus, Tamex, Qualcomm, who are slightly the early stage investors, and then we have Warburg Pincus, who's the late stage investor. And the joke is, so VCs are like the 1960s parents, so they have 10 children. So even if 2-3 don't do well, it is okay, chalta hai. The Ps on the other side, like a Warburg or probably even a Premji, in that sense, are like the 1990s parents, or like my parents were, in a sense. So 2 children, dono ko nikalna hai. Right? So you're behind them on tuitions, you're behind them on saying ki ye karao, send them to music classes, do this, do that. And that kind of defines the difference in between the approaches of both the sets of investors in a sense. I think a Series C or plus investor or someone like a Warburg, I think they'd be killed for losing the principal. In short, I mean, the guy would lose, they would be killed for losing the principal, while someone on the Series A side, I think, would be shot for not, taking a bet on something which could have been really big. So it's those two really. And so on the A and B side, I think, where the investors are far more involved, in a sense, is the vision. Are you taking more bets? Some of that stuff. On this, our late stage investors have been very, very useful in getting the governance and the financial processes in the company, up to scale quite a bit. And, as engineers and, as techies running companies, we tend to take some of that stuff very, very easily. And generally, till you hit some reasonable scale, there's no point focusing on some of that stuff as well. But once you are in the zone of, you've raised 40, 45, $50 million, is when I think, the investors who come in then are far more serious about, governance and, the financials of the company, how are you managing it, and some of that stuff.
At our stage, it's a team that has come together 1.5 years back, maybe 2 years back. At times it's very young. There are jealousies in between. So at times you have to act as an agony aunt. You just have to listen to various people. That hopefully doesn't happen at the Series C stage and beyond. So it is the early team. You're bringing in new people, bringing in people who are probably senior to these, in terms of age, senior to these guys, working for them. All of those tensions need to be managed. So it's a lot of psychology. I wish I had studied that subject more than I. It's a lot of that actually, and we have had terrible crying situations. Everything that you can think of. Those things kind of disappear as you go away. Imagine, and Anish kind of hinted at that. 2015. imagine if you're sitting inside a B2B enterprise software company, SaaS company, and he's looking at these Grofers and Snapdeals and Flipkarts and anybody and everybody doing some hyperlocal stuff or food tech getting $20 million, and this guy has a real business and he can't raise $2 million, okay? Imagine the kind of angst that happens. Some of it is probably coming out, if I might say so. But you have to manage that. We as board members had to manage that at that time. And now, when the tide has turned, you have to again counsel them that, boss, Schadenfreude or whatever, howsoever it is pronounced, doesn't get you anywhere. So they shouldn't move to the other direction. So maintaining this sanity is psychology. And I started doing a course in Coursera. I should complete it.
So, well said, Parag. So I think we've kind of covered that between the late stage and early stage. I think it's more about basically the focus on growth, focus on more risk taking, focus on new products is kind of a lot more driven by the early stage investors, and they typically are much more comfortable with it. While as it gets to basically more of the later stage investors, they are more focused on stability of revenue. They are more focused on stability of organization. Is the organization there? Governance is there. Processes are there. They start pushing basically the founders more into bureaucratic setup as well at times. I'm sure Bhaskar would vouch that. In the sense that we should have board meetings on time, we should have board meeting minutes at least printed out, sent to the investors, because in early stage in companies, you would not see any of this. Because board meetings can happen on a phone call where the founder is talking to three of basically a pile of pages that says, oh, these are, by the way, the meeting minutes from last year. And please sign it because we are getting audited now. So, so a lot of interesting... So, but it's not unique, right? It happens across every company. So I think those are some of the things. As the revenue becomes bigger, the company is becoming bigger. You have to start having more processes. Earlier, basically, there were 4 people, and we often have the joke because Wipro is a larger company and a parent, really, which Mr. Premji manages. And we are a much smaller organization. In our team, we have 7 people. And some time back, we had a consultant who came to audit our processes and said, there's no document trail here. I said, in 6 people, you're asking for a document trail. We sit in a conference room, finish the policy document, and it is there. So, but they're used to a 10,000 people kind of organization where there needs to be a document. So I think the difference is really that stark, where when the company is in early mode, basically 3 founders, 2 development guys, they kind of sit in a room, hash out everything about the product, and the product is done within a week or less than that. While as the company grows up, there is a lot of levels that are there in between. The communication is not as transparent and clear. So there are lots of issues that the company has to go through. And I think there has to be process built around to ensure that company still has that zeal and energy.
Typical situation is when you are finished your Series A, B, and then you also have a new investor, let's say Series C, D, investors coming on board. The play out from a day-to-day interactions to the board perspective, for example, and what we've seen historically is the earlier investors start fading away from a day-to-day strategic perspective or even the tactical aspects that we look at. And the later investors start to really participate further and further, which is, I think, the right way from a company perspective to look at, right? So that's one big change that we see. Having said that, I think a couple of things which I think Atul also touched upon is from a process perspective, and that's one of the hardest things, right? As an entrepreneur, every few years you are expected to almost grow up faster than a child in some sense, right? Because you have to change your behaviors differently because the levels are different in terms of what's expectations out of it. I think fortunately, we do that through hiring. We do that with people who are better in processes, and you don't change your own skin in some sense. So what you're trying to do is to bring in a CFO, for example, is a classic case that you bring in on board, somebody who's taking care of all of the basic brass tacks numbers. And interestingly, in my experience as well, like what Atul pointed out in our board meetings, and I can kind of, when I go back to my board meetings in a Series A investment board meetings, it's really about top-level slides about pictures and images and future of how things happen and what sort of the directions we're going. No numbers. Literally, I can tell you, I've had board meetings where there's zero numbers in the whole slide deck. And we had a fantastic board meetings with our investors in Series A. And I'm sure when Atul came in, there was a culture shock for him saying, what's this? Oh, this is a board meeting presentation. And you can tell, I kind of taken a full turnaround right now. And I think hopefully we're coming there, where you see a lot more numbers, a lot more things about how the business is happening on a real, on the ground basis, right? So it's a huge sea change that an entrepreneur has to go through from a transformation perspective, because both in terms of as the company grows, it's critical for us to look at it. So those are things to look at. Some interesting aspects that we also see is, for example, some of the investors, the early investors to the later stage, also don't grow up in some sense. And they grow up in terms of expectations from an entrepreneur. And that's one thing that I think I've seen it in many companies, right? Because during Series A, you have a lot more interactions, a lot more a particular sort of behavior in place. As the company starts growing up, how do we as investor and entrepreneur relationships also has to mature. It's almost like a child, right? When you're a 5-year-old, you need some taking care and see to it that the child drinks milk. But when they're really grown up and going to college, you don't want to be treating them, you need to treat them differently in some sense. That sometimes become harder for the early stage investors to kind of scale that and graduate themselves out of it. And that's one of the challenges I think that's interesting to look at from a dynamics perspective.
Just one point I really wanted to add is, more than what the investors want out of various stages of investors wanting out of the company, I think it's also very important about what the entrepreneurs want their board members or their investors to do. And that very often gets missed out. And I think it's very important that as entrepreneurs, as you get angel investors, board members, financial investors, you use them more than, it's great if we can use them for a certain purpose. Like a good example in our case is, so as we opened China, we realized that Warburg has a great China presence. So basically for everything that's China related, the Warburg board member is there with me on it. And then we got some of our very early angels back onto the board. I got Rajan back onto the board because I wanted someone who could really be a soundboard on scaling sales. There's no one better than him. And I think a lot of times as entrepreneurs, we almost think that you shouldn't go speak to investors too much. Or it's always a one-way relationship of the investor asking ki iska kya hua or what happened than the other way around. And I think that should change in the ecosystem a bit. This uncomfortable relationship in between investors and entrepreneurs, I think should change for better companies coming out.
I think in any relationship, basically, if it becomes uncomfortable, it is overbearing and will always have negativity and bad outcomes. So I think it has to work as a team. That is at least my experience. And one cannot go too far as an investor or as an entrepreneur. I think they both have to understand each other's expectations and align accordingly. Obviously, an investor, if it just becomes a one-side street, which I agree with you that in some cases it sometimes becomes, it ends up in a disaster most of the times.
Okay, I think I'm going to push my luck now, really, because, but I guess it's okay. We got enough from all of you, so I can push my luck. Okay, so do the interests of investors in various rounds get into a conflict? Okay. And what are some of the more common areas of such conflict, and how do these conflicts get resolved, and do they affect, as entrepreneurs, have you seen that affect your enterprises, or have you seen other entrepreneurs' enterprises getting affected because of inter-investor conflict? Are there conflicts of interest between investors at various stages as you go from A to B to C to D? Because as some of you alluded earlier, people come in with different expectations at each stage of investing. So what are the typical conflicts? How do they get resolved? And do they cause collateral damage to the enterprise?
I think that's a very good question because I think whether the company is small or large, I think these things often come because every investor is different. They have different time horizons because what you will also realize as you go out and talk to investors is which fund are they investing from. Means unlike us, which always have only one fund for last 10 years and probably forever, investors have different life cycles of different funds. When they were raised, they have 5 years to invest or 4 years to invest and then harvest. So they will, means most of the funds, they will work like a clock. When they enter a company, they want to exit within 5 years, and if the time starts moving, clock starts ticking, their LPs are on their heads and are pushing them hard for an exit. And I think India as such, and I just want to go back to Dr. Sabri's initial comments that there are about 20% or so exits. But if you look back into our history, and we actually did some data crunching, and we had one of the guys who covers this region, which is Cambridge, which does a good job in this, also look at some of this data. And what we find is that India VC and PE, typically the exits are few and far. Basically, in VC funds, you will find that typically, with most of the known ones, if you remove the period which is between 13 to 15, most of the VC funds basically didn't really see much of exits. And same was the case in PEs, means private equity funds hardly had any exits. And that is the reason they have dabbled into listed equities quite a bit to really show quick exits for their investors, that we invested money, we got some exits, and here is the returns. So I think these kind of issues, they definitely come up from between the investors, because if I am entering a company which is a pretty strong company and cash flow positive and basically growing at a rapid pace, and I'm looking at an IPO in 2 years from now, next year again, basically there is a large investor who wants to come inside the company. These are, I'm just talking to you about, even in PE, there can be a lot of conflicts, right? So there's another investor who wants to come in after a year because the company is great and they want to have it in their portfolio. Their view would be that I just came in, and if the company exits in a year, then the uptick on the company is not enough for me, because I want to see a 2x return on this company, and let me just delay the IPO by another 3 years. So let's move the clock. So basically, those are all causes of conflicts, and I think that is the reason when basically a round is getting raised, there is a huge burden on the previous investors who are sitting in the company and the founders to make sure that they align with the incoming investors well. Because oftentimes these become the point of issues later, which can impact the morale in the company. Means that if there is a constant conflict between the two investors, means poor founder is just caught, and he really can't resolve this. The only thing is sit down and talk and just agree on some path forward.
One good hack to it is to have an independent board member who is quite strong, who can then speak between both the investors in a sense. In fact, besides the exit, you also have a lot of conversations on strategy, on which markets to go behind, which markets to not go behind, should you go like international, etc., where you typically tend to see different opinions from different opinions on the of investors on the same board, and it can get tricky a bit in that sense. And at least in my case, I've had the independent board members who generally are more operators. You should get good independent board members who are serious operators who run their own companies. So when they say something, financial investors tend to take them a little more seriously. I think that's worked a little better for us. So,
I think what I have noticed from my experience is A and B, there is not too much of conflict. C is when it starts.
Trying to be kind of fair to both sides, because one is actually invested in you, trusted in you, brought you so far. The other who's coming in and wants to really expand the company. So there's clearly an obligation on both sides, and being fair and clear is critical in some sense. Having said that, I think conflict is real. So there's a real conflict fundamentally from a structuring perspective. So the business structures are by definition conflicting. So a lot of the time in a fundraise, for example, is spent on trying to kind of get this arbitration done in a fashion which is kind of realistic for everybody and being able to manage that. And it's not only about the exit timeline, which is one part of the problem. Others do exist, for example, in terms of rights on a board, what sort of decisions, who's going to participate in these decisions, for example, decision-making process. How is the strategy going to be driven? And it's very critical because from a mindset perspective, an entrepreneur also, I kind of try to change because initially it was one board member, have a call, we are done, we're just taking decisions and moving forward. As you start becoming a multi-investor company, then the questions come in terms of what are sensitive to each of the investors, because each of the investors have their own hot press items, right? It could be different. It may not be affirmative rights on your shareholder agreements, which are one part of the problem, which is more regulatory in some sense for me. It's really about each one of us have pet peeves as investors as well as entrepreneurs. So how do you kind of balance that? And how do you create a structure and a fora through which you manage it? Because board meetings are every quarter and business run every day. So it's critical that how do you make decision-making processes which kind of carry everybody along. And so ground rules and creating mechanisms where there's a forums created, committees formed, and real-time feedback and things that we put together, it becomes very critical for us.
I think I should open out the forum now to audience questions. I repeat what I had mentioned at the start. I'd appreciate if we can keep the conversation fairly focused on this migration from A to B to C to D, rather than ask the investors here or the entrepreneurs here, how do I go about raising a Series A, right? So this conversation is about the transition. If you can confine the questions to that, that'll be great. Yep.
I'm Anand here. This is question for Anish. I believe that once you go through Series A, B, C kind of rounds of funding, your stakes are going down, right? So I believe, and one more thing is that you guys are into SaaS model, and I think there is no problem in terms of getting exit or going for IPO. If you want to stick on the business for next 10, 15 years, is there any plan for you that to buy back the stakes from the investors? Or if not, like, is there any option you think about?
No, I think that's a good question, and I think a lot of founders in that vintage, the 2008 to I think 2012, all of us have over-diluted ourselves in our enterprises. Around the 10% equity is any founder in any large good company, around 10% is the equity ownership. So it's so you do dilute. But I think the important piece is I think you should also look at the size of the pie, not just your ownership in that pie, right? And the second is there is financial ownership, and then there is in a sense management ownership of the company. So as long as, and hence as the size of the pie is growing, even your net value of the percentage that you own will mean that, you're owning more in terms of the net thing. So I would not be very concerned on on how much, you own. In a lot of cases, at least in my case, I've got multiple times our investors to claw back equity. So as we hit higher revenue thresholds, we get, the founders and the management team get more equity back. So that's something that we've done. I would not look at buying back the investors. In fact, if you really ask me, just given the stage of the ecosystem in SaaS, and again, very profitable, you can over a period of time build nice cash businesses. Cash businesses, not cash in the negative sense, but cash generating businesses in SaaS. And hence, there's a lot of interest of private equity folks to buy out our Series A investors. So I would not buy back the investors. I would probably facilitate an exit for them in some other means over a period of time. And multiple examples, the way Warburg sold Quest to someone else. There's multiple cases where cash generating companies, reasonably profitable, have been able to peddle the equity. So I don't think as founders you need to really buy back the investors. And to claw back more equity, the right way to do it is probably to, set aggressive targets and let the board, and I've generally seen good investors being happy about it, returning 3-4%, 5% of equity every 3-4 years as the, company is really growing and they're seeing their value of the equity also grow.
So as I understand, the early stage A investors are usually at a stage where the company is not really making money. And later stages, you have to show in profit. So for a high-tech company, say, for example, we're building appliances that can cook food for the consumers, and the market is generally outside, it's abroad. So how much sense does it make for a company to raise their B, C, and D funds rounds from funds in India? Does it make any sense at all, in fact? That's my question.
We are loss making. That's not stopped me from raising money. And I think you have investors of all types in India, who would put money even when you're loss making. I don't think that should qualify anyway. I think what matters more is as the stage of the funding changes, the unit economics keep changing. So as long as the unit economics are good, I think you can raise from even Indian investors. I don't think that should be a problem.
If the market is there, the investors there would have a better sense of that market versus the investors here. Because, for example, if I am looking at India, I know what works in India and how does it work. Because again, there are certain expectations people can build, and then those expectations may not be right from an investor perspective, and it can be a cause of a conflict also. If you look at even the larger firms, even Vodafone, trying to do their IPO in India, the main reason is that this is the Indian market, and we should raise money in India because people will understand the market conditions. Versus sitting in US, investor will fund the India arm, but suddenly the pricing changes here. They don't understand what is the dynamics happening here. So it's always better, in my view, that you get the investors which are in a region where you are trying to build your main business. However, if you are only thinking from a diversification point of view that you are planning to go into some of the markets, then I think it's a normal thing. But as I think Anish pointed out, for the later stage investors, it's not about that you have to be making lots of profit. It is about the path to profitability is clearly visible. So, obviously there are different stages in it. One can be coming in a bit early when you're still making loss, but your business model is such that the path to profitability is visible, and they would probably want to invest with you. And hopefully over a period of time, you will get into that profitable mode with a scale.
One quick point to add there. There are a lot of investors who have cross-border teams. So if you look at an Axel, a Sequoia, a Warburg, they have cross-border teams. So although the investment is made by the India team, you have partners in the US, or like the example I gave you, the partners in China helping me. So you should probably think of people like that. But I think it's always better to take money from investors who are in your same geo.
My question is related to something which is going to become a reality, which is down rounds, right? So how do you deal with conflicts between the entrepreneur and investor? And I just wanted to understand also from an ethics standpoint whether anti-dilution provisions like ratchets, how do investors feel about it? Or is it negotiable? Because at the Series A level, entrepreneur just wants the money, right? They sign the shareholding agreement without understanding repercussions of all this, which comes back to bite them in the case of a down round, which is becoming an increasing reality today. So I just want the investors and entrepreneurs kind of...
Is your question directed at anyone in particular, or?
I think everyone, everybody.
Okay, right.
Yeah, Parag maybe, because Parag might be seeing more of it. But of course, Atul, you as well.
No, this is fine. So yes, just to clarify, that's not typically, we have not invested in the hyperlocal and stuff like that, so we are better off. But that is, in some of our companies, it will happen. It has not happened, but it will happen. And it's very hard. It's very hard. Some of those mentalities that people came with in Series C, Series D, that they thought it was an established business, especially in a technology company where things change very fast. Facebook and Google might do something and things might change, for example. It is a reality, and it has to be taken care of at that point in time. Those discussions are never easy. It has to be entrepreneur-led. The entrepreneur has to decide what is right for him, etc., etc. Let me give you an example of an entrepreneur. I'll not name him, but I just respect his intellectual honesty so much. This happened some years ago. we read the clause of a previous, there was an anti-dilution event when we came into the company. We read the agreement that way. The previous seed investor actually took the benefit of the anti-dilution. 6 months later, the entrepreneur went back and read the clause and found some defects in that clause. He could have taken advantage of that and gone back to the seed investor and said that it was not full ratchet anti-dilution. That's not what the clause actually reads. But since he had agreed, he had given his word, he still kept his word. So some of these things also depend on how and I'm not saying every entrepreneur should do that, but this entrepreneur took that view that I'll not revisit it in spite of knowing that the agreement was on his side. Yes, the event had happened, so it was after the event, but if he had raised it, I'm fairly sure the seed investor was mature enough to consider his request, so to speak. So some of these things are bound to happen are happening currently as we speak.
These things happen all the time, right? So I'm not going to say some cases they might be right, some they may not be right. I think investing is not just about exchanging few papers and basically signing below the name somewhere. It's a lot more about building credibility and alignment between the partners. And there have been instances where basically investors are very, I would say, they want to work together with the founder and make sure that those provisions are not initiated or executed. In some cases, they are not. And I think it really goes back, in most cases, to the relationship between them. Secondly, I would say that while taking the investment, and this is a little bit of a controversial point I'm making, that while taking the investment, an entrepreneur knows how the company can grow. Because he has the knowledge which most of the investors, or I would say none of the investors will have about the business. An investor coming in with a very high valuation is suddenly being accepted by the entrepreneur is also because of a greed. And that entrepreneur putting an anti-dilution clause for that kind of a valuation is a very valid point, because he is giving you an exceptional valuation and is asking something in return, that if you do not hit the metrics, then I should be able to claw something back. So I think it really depends from situation to situation. And I would say building relationship and being realistic between the two of you is typically the most, the best solution that you can have. Even after that, yeah, you will have instances where basically things may not go the right way. I think we can all debate about the ethics, but basically this is business, right, at the end of the day. And it's written on the paper, people have agreed and signed on it. So that's ultimately the bottom line. But I think with relationship, with the right mix in relationship, you can solve it.
If you take the parallel for a public company, where something happens and then the stock price goes all over the place and the founders and whoever are ESOP holders go all over. This is a parallel to that in a sense, right? So, the stock price has got reset and, your value is down, the investors keep their value in a sense. I think there's nothing, I think the best way to handle it is as founders to go back and make sure that the employees are not hit as much, because employees get stock at a very different valuation to what. If you're able to get through the morale issues of a down round, I think you should take it and move. It's better that you survived than you died. So anything is better than a zero for that matter, right? So, yeah.
It's about a relationship. I don't think there'll be many investors who want to screw the entrepreneur and actually make the company successful. It might be hard to do it as well, right? So there is always a balance of trying to make this happen. I have not seen investors walking in and saying, anyway, I don't care about you guys, but we need to get it done, for example. But I don't know about the anti-dilution situation both from a legal or other standpoint. And I think all of us have this conversation, and every time there's a shareholder agreement coming in, is this anti-dilution ever going to work? How is it going to work? And the complex equations only the investment bankers know, literally. I don't think I've ever opened it and figured it out, because if you read any legal document, it's very hard to figure out whether you're going to make it or not. So in that sense, it's becoming more complex from equations and the structures that we've started building in. I think eventually, as an entrepreneur, I just fundamentally believe in trust and say, hey, are these the right investors to work with? And are there going to be bad days? For sure. Are there going to be good days and bad days? And how do we kind of treat each other? Is much more critical and important than I think what you sign in the paper eventually. Yes, but in letter and spirit, we are signing to it and getting in. I think that's part of the business. Actually.
Okay, so in keeping IMB and NSRCL both, believe in starting shows on time, ending shows on time. So keeping that in mind, we have time for probably 2 or 3 more questions max.
My name is Sudhir. The question is for the investors in the panel. I think the perspective that I got, Parag, from you during the initial part of the discussion is the success of a company is possibly measured in terms of what the customer gets and what you have, the residual value that you build for yourself as a company, right? It's an excellent perspective. Now, specific to funding beyond Series A, right? If you have to choose, what is more attractive? If you have to choose between a brand and an IP, what is more attractive there, right? That's question 1. Question 2 is if you're saying if it's both, then can you please put a percentage to that?
I think IP, honestly, is at times overemphasized. Okay, IP leading to business value, I would say should not be underemphasized. IP leading to value is fine, but people get stuck on patents, for example, just for the sake of it. And we have enough examples of patents not getting anywhere. It's a niche, for example, and that doesn't lead to a lot of business value. But at a broader level, with that qualification, at a broader level, as an investor, I am actually indifferent where the value comes from. I have invested in companies where the IP is so important, whether patented or not, that the success of the company, and it's a fairly early stage company, so I can't give you what has happened. I'm just projecting forward there. 90% of the value of that company will come from, even if that is in the form of revenues and valuation, etc., that will come from IP. And I have companies where 50, 60, 70% comes from a brand. So I'm indifferent, honestly. My idea is to put in X and make 10X at the end of the day. The rest of it is a black box, isn't it? That's the clinical mechanical engineering view of the situation. So so I'm indifferent there, but with the IP qualification.
I would pretty much agree with that thought process. Basically, it really depends, I think, how you use it, what kind of IP it is. In our business, we focus mostly on consumer themes, and there, obviously, brand matters a whole lot. There's hardly any IP in most of those businesses, except when you get into some of the tech-focused businesses. So I would have a mixed view on that, to be quite honest.
Okay, I have to follow a simple rule, which is that whoever has the mic gets to ask the questions. Having said that, I regret that I have no control over who gets hold of the mic. So
I have a mic.
Find your own way of finding a mic. Can I just, you had a question in the previous session, didn't you?
No, this is something very...
He didn't get a chance, sir. Then the name of egalitarianism? Can I just...
Hi, I am Bharat from Native Bag. I am the last row. The question is related to the crowdsourcing. So kind of think like there are like 30 investors in a company. And then this early stage starts or the investment firm comes in. So how this crowdsourcing or this investment of like 20, 30 people will impact the company, and how as an investment firm you are looking into this? Like what will be the step you will take?
Is it addressed to anyone in particular?
No, in general, anybody can answer.
Who wants to? You want to take this or probably closest to where you are?
So we had 17 angels. And back when we started 2008, it was not like raising money was easy. And we were doing SaaS, unheard of stuff in markets. I think the investors take it fine. The only thing that we got in as a clause was we are a Singapore headquartered company. So we said all decisions can be taken with a 80% ownership for a set of decisions. So for everything, you don't need to go get paperwork done with all your small angels. But otherwise, we never seen, in fact, I've been very lucky to have some really marquee angels. Some of those 17 have been like really, really useful for us. So I don't think it should, at least from an entrepreneur standpoint, I don't think it impacts. So.
So I think put some structure around it, as he said, either the one that he said, or for example, one of those guys leads it. I've had a situation where an angel investor has told the entrepreneur, I have given you 1 crore, so you need to listen to me. He actually said that, you know. So you don't want that kind of situations. You don't want to listen to a guy because he gave you 5 crores, 1 crore. I don't care. You need to listen to him because he speaks sense. So cover yourself for that scenario. 17, 18, 20, 30 investors I've seen at times get you into trouble.
Where basically in a company there were 400 investors holding 10, 5, 20 shares each. And it was a nightmare even reaching out to them for the guy. So basically,
Won't they be deemed public?
Sorry?
Won't they be deemed listed if they had that many investors? Seriously, I mean, under company law, I thought they would be. Yeah. Anyway.
So I think it can become a nightmare in itself, especially when you go towards later rounds of funding. And initially, none of that matters. But as you get towards IPO or you start looking at some of those things, then they have to be on each and every paper. It's just logistically impossible to kind of manage such large angel list.
Actually, I'm from a startup company which moving from going beyond Series A, looking for a Series B sort of investment. So there's a thought process. It's maybe a question. You may get it. One is investor and the founder relationship, conventional and unconventional funding. Third is when an investor thinks.
Sorry, John, do you have a question?
Yes, the question is,
yeah.
when an investor thinks, he can't put all eggs in a basket. Why can't an entrepreneur can think all his ideas, just go in different entities in the entrepreneur startup itself? Why should he all grow as a single company and bring it?
Okay.
See, unless and until an investor, we are willing to write off our money. I said it is a swag, isn't it? So 2 out of 10 of our companies will fail, and that's fine. But they shouldn't fail because of lack of effort. Okay, that is inexcusable. And 4 companies, if you have 4 companies, and God forbid the 3 that are doing well are the ones that I am not in there, then what happens? Okay. I don't care about relationship. I am responsible to somebody for the money that he sent to me. At the end of the day, I don't care about relationship. That's the way it has to be.
What I'm saying is, it saves the entrepreneur also. Is 3 entities running good, 1 entity goes right, it gets good.
No, I think at some point,
this is a debate. The other 3 entities.
This is a debate that can go on forever. I think there is a certain established
I don't think
way
enterprises, I don't think, as founders, if you're doing 20 things, your enterprise is anyway going to succeed. None of those 20 will succeed. It's not easy building good companies. It's very hard. You need to really live that problem day in, day out. So those 20 companies will anyway fail. Those four companies that the entrepreneur is running. So I think it's better for the entrepreneur also that this guy put some discipline in, saying you can't do much.
My question is to Atul, and this is from moving from Series A to Series B, and directly linked to the parameters that you measure, which is unit economics and the maturity of the company. So the question is, unit economics is in place, contribution margins are good, 30%, 40%. But typically the question that comes up for Series B is, contribution margin is good, but it's not meeting your indirect expenses and thereby you're not profitable. So is that a Series B issue or is that a Series C issue? Because I'm going into Series B, and the questions are raised are, you're not yet profitable. Contribution margin is very healthy, perfect, legacy, you've proven it. That's one question I would expect. Second similar question is, your model is good. You've done a good job. You've done it in a territory. I would like to replicate it in multiple territories. I just want to grow the same thing. Then the question is, it's not yet proven, which means that you've not replicated and come back. Now, question is that Series B or is that a Series C level?
So from my perspective, basically, the way I look at it is, at least when it comes to us, all of those questions are answered broadly.
At Series B level?
Series C and D levels. So pretty much even in healthcare, we would not invest in a single center healthcare center. We would want it to be replicated across a few centers, hopefully out of one city, not in one city either, multiple cities. Similarly, if it is a business, it has to replicate itself, not just in one category, multiple categories. At the end, it's a one category business. Then it has to replicate over again, multiple cities, multiple formats, etc. So I think that's that part. Series A, Series B, Series C. So I think there are two questions here, and the way I'm seeing it is, one is basically at what level should a Series B investor be interested? And I think one investor's perception of the business may not, you should not extrapolate it to every investor in that segment looks at the business the same way, because that is also very important to understand. So if I look at from a Series A to Series B, as I said, if the unit economics seems reasonable, it can be profitable at a certain point of time, and you can convince the investor, and he or she believes that basically the rest of the costs won't scale as your revenue is scaling with the same rate, then I think you guys are in sync broadly, and the business model has some wings. Second question they will obviously have in their mind is scale. Is the business scalable enough? Because unit economics might be great, but is it scalable? Because I remember looking at a company in photography space, where basically great unit economics, great product, and good penetration, but it just could only be 100 to 200 crore kind of a market. So I think from an investor perspective, that is the second aspect that they will try to put. It's a great business, but it's a business which the founder should just run by himself. They should not bring in an investor, because the investor's expectation is scale. And then the second aspect of the second question that I mentioned, that if I am as an investor saying, look, I don't like that you've not replicated it, but there might be another investor who might say, look, I believe that what you have done in this city is great, and I think this can be replicated. So a lot of these things are experience, a lot of these things are at what point in cycle they are at, what kind of companies they invest in, because every investor has a slightly different perspective. These are different individuals. They don't decide on just one fit or one cut fit all kind of thing. So I would say that that's...
So thanks a lot for being such a wonderful audience. Thanks for those wonderful questions. Thanks for being so patient. But thank you. But before I close, I want to thank all the panelists. Running a Series C or a Series D company is a 27-hour job. Okay? I'm very grateful to Anish and Bhaskar for having been here this morning. And please give them a generous round of applause. And much as people would like to think writing out checks is easy, I want to tell you, having done that before, it's not easy, and it's more than a 27-hour job. And thanks to Parag and Atul for being here in spite of their busy schedules. Thank you all the panelists. And before I close, I want to thank the team at NSR Cell, Keshava, Vrinda, Akash, and all these people who make any of these shows possible. We actually we announced the show just 15 days back. And to put together a show with this magnitude, so many people inside the room, I think full credit goes to them. Thank you all very much. I want to hand over the mic to Akash.
I think what this session really has been for the entrepreneurs is like a peek into the future. Now it kind of helps them re-engineer their thinking towards the future. And just to add to that, as a follow-up to this session, we are going to have a session on angel investing for startups in the current economic scenario on Friday, 10th of March, 6 p.m. in the auditorium. So please do join in for that. And on that note, on behalf of Team NSR Cell, we would like to thank each of the panelists, Mr. Parag, Mr. Anish, Mr. Atul, and Mr. Bhaskar. Thank you very much for being here on a Saturday, and the time is precious. So For Startups is a completely pro bono initiative, so the best way we thank the speakers is by giving them a standing ovation. So thank you all for coming in.